Investing entails making a financial commitment in order to get a financial return. This essentially means that you invest money in order to make money and meet your financial objectives. Hello everyone, and welcome to a brand new video on the channel. Today, we're going to talk about Investing 101, a beginner's guide to the stock market. Before we get started with the video, don't forget to smash the like button, share the video, and subscribe to the channel. Now let's get started. Diversify your investments. Diversify your investments rather than focusing solely on a stock you believe will do well. By doing this, you can protect yourself from a total loss if one aspect of your investment doesn't work out. Depending on how you respond to the changes, there may be a greater risk. Many investors find it challenging to stick to their investment strategy, especially when markets are volatile. You can better control your emotions by having a diversified portfolio that is subject to fewer market fluctuations. If all this talk about portfolio diversity sounds like a lot of work, it is. For someone who wants to diversify their portfolio but doesn't want to put out the work of buying numerous assets such as stocks, bonds, and real estate on their own, automated investing is a viable alternative. Invest for the long term. Invest for the long term if you can. Numerous studies show that holders of equities for more than 10 years will be rewarded with better profits that outweigh dangers in the short term. However, neither this tendency nor the possibility of risk eradication are guaranteed. Risk never goes away, although you could argue it gets softer with time. You can afford to have investments that are normally more prone to increasing and falling prices if you can save money for a long time. Equities, which tend to be more volatile than bonds, might make up part of your portfolio. Diversifying your portfolio is essential, regardless of how long you want to invest. Additionally, if you invest for a long time, you will profit from the power of compounding. This is the method by which the money you make gradually accrues interest. The benefits of compounding over time increase the earlier you begin investing. Watch out for high fees. Fees are money you pay that goes into someone else's pocket as opposed to your own. No matter how you invest, fees will be incurred. You should be on the lookout for expensive costs. They will significantly reduce your returns. You must take into account the value you receive in exchange for fees. On a $10,000 starting investment with a $300 monthly payment for 30 years, here is how fees affect gains. A professionally created financial portfolio that can be modified as your life evolves is well worth the cost. Additionally, services like automated rebalancing are useful because they guarantee that your portfolio always has the right mix of assets. A superb combination of these services and affordable costs can be found on some online investment platforms. Consider how much time you can put into investing. It can take some time or a lot of time to manage your money. Think about how much time you can devote to managing your finances before you invest a single dime. Making regular trades and making sure your investments stay on track are requirements of a DIY strategy. Although using a robo-advisor will cost a bit extra, it won't take as long. Your time is saved because the platform manages your investments. This is something to keep in mind at all times. According to Wealth Awesome CEO and certified financial advisor Christopher Liu, make an investment plan and stick to it. The fact that many investors sell their investments at the wrong moment is one of the main causes of their bad returns. They frequently make decisions based on recent results. They consider what has lately performed well or poorly. Many investors have a propensity to purchase items whose worth has increased and to sell items whose value has decreased. Instead of doing this, you should develop a plan that you believe will enable you to achieve your objectives in the time you have available. Don't give up investing due to poor results. Follow your plan without purchasing or selling. Depending on your predictions of what may occur soon, risk versus reward. The foundation of the stock market is the idea that investors will only make investments if they receive compensation for incurring the risk of purchasing stock. Consider this. Nobody would buy any stock they anticipated would increase 1.5% annually. You might be able to earn the same or even higher returns from a variety of alternative assets that don't involve the same level of risk as stocks, such as a smart savings investment account. To take on greater risk in order to receive the same return would be absurd. The idea of the equity risk premium is one way to examine the risk versus reward trade-off. This is a projection of your projected return from stocks. Stock picking. You would be wrong to believe that the best way to profit from this phenomenon is by selecting one stock. Warren Buffett, who is regarded as the best stock picker in the history of the world, frequently counsels everyone who will listen not to try to choose specific stocks in order to gain from the rise of the broader market. Diversification. If our explanation of diversification has made any sense to you, you'll probably wish to make investments in stocks, bonds, and real estate. One approach to diversifying your risk is to do this. Say you decide Netflix stock will provide you with the best overall return. It might, if history is any guide. What if Amazon finds a way to steal Netflix's lunch, though? What if viewers' preferences shift and they decide they would rather watch humorous kitten videos on YouTube than pricey dramas? Both the stock and your money would be destroyed. Due to this, you should diversify your holdings by purchasing several stocks across a variety of stock sectors, in addition to bonds, real estate, and other assets. This implies that if just one sector experiences a significant setback, your portfolio won't be wiped out. When the dot-com bubble burst in 2000, several tech stock values fell. You would have suffered a severe loss if you had put all of your money into computer businesses. Investing in stocks via ETFs. The best approach to diversifying a portfolio is to put money into mutual funds or exchange-traded funds, which serve as wrappers for hundreds of different stocks or bonds and often have portfolios that closely resemble well-known indices like the S&P 500. You can put your money in market, tracking index ETFs with a variety of investing companies. Investors should think about diversity as well as the costs associated with their assets. The so-called fees are like the termites of investing. They never stop munching and never feel satiated. The percentage of the total fund that the mutual fund company deducts each year to pay its managers, support staff, advertising, rent, and just about anything else you can think of is known as the Management Expense Ratio, or MER, and it applies to actively managed mutual funds. That's a wrap on the video. I hope you liked it. If you did, let me know by giving it a thumbs up and do not forget to subscribe. Thanks for watching. See you next time.